Hi everyone, my name is Richard Perry and I'm the market analyst at HANTE Markets, and I'm going to be talking about my latest webinar on economic indicators, which is on growth this time around. Now before I get into it, I'm going to quickly show you the disclaimer, because I'm going to be talking about live market information, and you need to have read and understood that the fact that I'm talking about live market stuff, and it's sort of my own personal views. It doesn't necessarily make it the views of HANTE Markets or anything like that. So yeah, just read and understand the disclaimer. Before I get into it, quickly look at what we're going to talk about today. Look at why economic growth is important for your indicators and your trading. Which indicators you should actually be looking out for, including growth, GDP numbers, and PMIs data especially, and then a look at how the growth indicators will be impacting on markets. Throughout the webinar, if you've got any questions, please just type them in the question box or the chat room, and I will try and answer them as and when they arise. But if not, I will hopefully see them if I haven't seen them. But generally speaking, if once I get through the data, the economic data series, then I'm going to be talking about live market information. So hopefully it'll take me about up to about 1:30, and then I can do some live market stuff for the last sort of 20 minutes, half an hour. And as ever, if you've got any questions or anything like that, please don't hesitate to ask me about what you're trading, and we can try and get to sort of do some more work for you as well. So I hope that'll be helpful for you. Okay. Right, growth. Now, growth is important, and first week of the month, we get a lot of growth data that has an indication on what economies are going to be doing, and ultimately, growth is considered to be the primary gauge of an economy. There are many indicators released through the month that provide information on how an economy is performing, but the most widely watched indicator is GDP, but also markets are increasingly taking notice of the PMI data, which is a purchasing managers index in survey data, and both these factors have a big impact on the market as well. So why is growth important? Well, because if you can generate growth, then you can get to a situation which you can create a virtuous circle for the economy. You can create, if you're growing the economy, you can create jobs growth, you can create employment, full employment, and that sort of generally lends itself to better social well-being, and also consumer spending as well, and it sort of creates a virtuous circle. But on the flip side of that, if you see growth declining or even going into negative territory with recession, then you can get into a vicious cycle as well, whereby you get the economy slowing down, unemployment going up, and markets certainly are therefore very take into consideration what the growth numbers are doing, because they have a big impact, as ever, on monetary policy. Now, there is an economic theory that sort of talks you through the links between growth and unemployment specifically, and that's the OKUN'S LAW. It's sort of an economic theory that basically suggests that a 1% increase in unemployment would actually cause a 2% decline in GDP. Now, this was devised by a guy called Arthur Okun in the 1960s, and he was sort of looking at the US mainly, but obviously it has a sort of feed through to other economies as well. And there's something also called the Okun coefficient, where it depends on how flexible the labour force is in terms of how it reacts to unemployment. In terms of how it subsequently feeds through into growth. Now, as you can see here on the chart, this is the US since 1978 to 2013. You can definitely see that there is a trend there of when you get higher annual change in unemployment, you get lower growth, and obviously you want growth to be unemployment to be improving, so therefore unemployment change being negative, so therefore you'd be pushing for stronger growth data through that, and that certainly is something that the Federal Reserve will look at. So the Federal Reserve is certainly takes note of growth data, and certainly obviously also puts it into its projections as well. So it is directly involved in looking at growth numbers. So I mean, sort of similar-ish to what we were just talking about. Really, why would economic growth matter? Obviously, if you're a central bank, you're looking to improve growth because you know that it's going to lead to a strengthening economy, as I just said, through the virtuous circle situation. You sort of look for improving economic growth, which drives a hotter economy, and just basically sort of pushing back to the inflation webinar I spoke about last time out. The central bank is always looking for positive growth, but with a sustainable level of inflation, because you don't want growth to go through the roof, because subsequently you'd see the likelihood is that inflation would go through the roof as well. Therefore, they would have to be far more tighter and quicker with their monetary policy tightening, and that would lead to certainly some concerns and sharp volatility in the markets, and they don't necessarily want to do that. So they would rather go for strong growth but in a sustainable fashion, and as with other economic indicators, is they're looking for sort of like the Goldilocks scenario, where it's not too hot and not too cold. Because ultimately expectations of the improving economy drive up expectations of tighter monetary policy, and as I said, if the economy improves too quickly or goes out of control, which was the initial, actually, just sort of as a bit of a tangent, it was the initial concern of quantitative easing, actually, whereby the economic indicators would subsequently just run away from the central bank without them being able to react quickly enough, and so subsequently they would need to sharply increase interest rates to try and deal with it. So they need to they're sort of looking for strong growth but in a sustainable fashion. So what are the key growth indicators we're going to be looking at? Well, first of all, GDP. It's a quarterly data series, and it comes out through 3 separate readings on a monthly basis, generally about 3.5 weeks, I think, after the month end. So sort of right towards the end of the first month, after the end of the quarter, is the first reading, which is the prelim data, and that generally tends to be the most sort of sensitive to markets, and what you're looking out for is the big economies, the big driving economies, to be the major economic growth indicators that you're looking at, which is obviously US and China for the moment. And even though GDP is a backward-looking bit of data, that's because of the impact that it has on central banks, even going forward, with regards to the second and the third readings of GDP, it will still have an impact across the markets, even though that GDP data is, at the end of the day, almost sort of 2.5 to 3 months old in the final reading. If there's a big revision in the final reading, that will still have an impact on markets. The other data series that is increasingly important is the PMIs, the Purchasing Manager Index surveys. Most countries use manufacturing and services as their PMI data, because obviously they are the two major sectors that you get in the markets, and these sectors will certainly have a big say on how well certain aspects of asset classes linked to that country will be performing, depending on how the weighting of that sector is. Say, for example, the US, say, for example, China in recent years, the Chinese manufacturing sector has obviously been massive and the big driver of growth. So everyone's been looking out for the Chinese manufacturing PMI. Whereas increasingly what you're going to find going forward is as the Chinese economy turns and realigns towards the more service sector based, it's going to be the service sector PMI in China that's going to be the more important bit of data. But certainly for now, everyone always looks at the manufacturing for China. And other factors we're looking at include sort of like the industrial production data, capacity utilization, Fed surveys, factory orders. Now, industrial production for the US, for example, this sort of accounts for 25% of the economy. So it is a strong indicator of the country's future economic growth. And certainly if you look at the capacity utilization, that sort of shows the degree of capacity that the industrial sector is running at. So the higher the data, the higher the number, the better. So capacity utilization sort of up in the, if it was up around the sort of 70s mark, would be better than sort of 60 or obviously 50, because it would show that the economy or the industrial sector is running on at a better pace than obviously than it would be if it was lower. I'm increasingly looking at the Fed surveys actually as an economic driver, and we've got here the show you the Fed surveys. Now, the Fed surveys are a problem, I think, for the States. I've sort of focused on this a few times in my interviews on TV and in my research as well, and I think that they are a problem because you're showing that basically when it's below zero, it shows below trend growth. And you can see that New York is a big problem there. Philly Fed, which is Philadelphia. Richmond's pretty much the only one that's positive. And you've got Dallas, which again, look at that, Dallas, lowest since 2009. And also Kansas City as well. So across loads of these regional Fed survey data, they're actually in decline, and that would suggest that these the sectors which they mostly cover manufacturing would suggest that the manufacturing sector in the US is in a real problem at the moment, and it continues to slow down. And how much that feeds into the broader economy, obviously 25%, as I said, it's not the biggest sector, but certainly has an impact on growth, and it has links to growth. And obviously what we've seen recently, which I'll talk about in a bit, but is the manufacturing PMI in the States also suffering as well. So it all feeds into each other and all gives you a bit of a lead indicator, I think, on these Fed surveys. And new factory orders as well. Again, that can be a bit of a forward-looking data. Certainly for the manufacturing sector, and also looks sort of is a little bit less spiky and a little bit more useful, arguably, than the durable goods. So new factory orders is also something that I look at. So starting with sort of focusing mainly on GDP now. GDP is the primary measure of global of sort of growth of an economy, and it is the total amount of goods and services that a country produces, and takes account of the annual growth. So the percentage change from year to year is what you're looking at for here, and obviously plays a fairly central role in a central bank's views on the economy. Comes out as a quarterly bit of data usually. Now, as I've got here, the first reading is about 40% of the economy is taken into consideration in the flash reading. So it is subject to serious revision, but the market will obviously be taking on board that first reading, which is a good indication. It's not ideal because it is only 40%, but still, about a month or so later, you've got the second reading, which is 70%, and then the third and final reading, which is about 2.5 months after the quarter end, is over 90%. And even then, you can have revisions to previous previous quarterly growth figures. I mean, for example, the UK was there was famously close to a double dip recession. It then got revised out, and also recently you had the similar sort of situation with Japan, whereby they were their a revision to their GDP data meant that they on the data wasn't actually in recession at all. Now this chart you've got here just shows I think gives you a very good indication of why the US and China are so important. China, according to this chart, is around about 8 trillion. I've sort of worked it out at, and it continues to grow and grow strongly. And that to get to 22.2, it would need to grow at about 7% per annum for the next 15 years up to 2030. And then it's getting close, isn't it, to the US? Not too far off it. As you can see here, by that year 2030, India would also overtaken China, and Japan continues to grow as well, very slightly. But you can see here just the fact that the US and China absolutely dwarf all these other countries in terms of economic growth and the size of the economy, which is why everyone's so intent on the growth data for these two countries. Now, I talked previously about the fact that the central banks around the world target inflation and unemployment quite often, but the Central Bank of China, the PBOC, also targets growth. The Communist Party in China always puts out a target for the year, and policy throughout the year in China is sort of geared towards generating that target. So that obviously involves the People's Bank of China trying to generate growth as well. So subsequently, any signs that the Chinese growth is slowing down would generally tend to mean that the market starts to speculate on whether they're going to be doing easier monetary policy, because it is so because it looks to try and achieve those targets. So a very important bit of data there for growth in China. And the PMI data. Now, the PMIs are, as I said, increasingly becoming popular. And basically it's because they're forward-looking. They're a lead indicator. They're basically a survey of purchasing managers through the sectors. And the respondents are actually given asked questions on a number of different sectors or factors, including production, new orders, supply deliveries, inventories, and employment. So pretty much a broad indicator of the sector. And then obviously that data is compiled and put out once a month as the PMIs. Now, another reason why it's very strongly market moving is that it's pretty much the first piece of key tier one economic data for the markets, and it happens. Manufacturing PMIs is always the first working day of the month, and service sector PMIs is always the third working day of the month. And the manufacturing PMIs obviously have a big, strong lead through to growth, and certainly the Chinese data, which is due to the sort of obviously the way the world time zones work. Chinese manufacturing PMI is the first bit of data that comes out that basically just drives early morning trading on the first day of the month. We had that yesterday. You had China PMI came out and again negative, again disappointed, lower than expectations across the official data, and also in contraction territory. And I'll talk about contraction territory in a bit. But the fact is that drove the correction in oil, that drove the correction in the markets, and we're still seeing the legacy of that today. And I think that is obviously going to continue until tomorrow. Tomorrow we get the service sector PMIs. Now the service sector in China, I think, is around about 51-52% of the economy now. So increasingly it is going to be becoming the more important bit of data. But certainly for now, manufacturing is still important. But tomorrow you could well see if the service sector PMIs improve in China, then you could start to see a bit of a turnaround in sentiment again, but we'll wait and see how that goes. But certainly the PMIs are important. And you can see that the link that PMI data has through to growth. You can see here with the China data. This is all sector PMIs, so that's the amalgamation of the manufacturing and service sector PMIs. And you can see that they do pick the direction fairly consistently. Similar to the US here, you see the falling PMIs in 2009, rallying, recovering PMIs, and then sort of like the fluctuation. And we're seeing at the moment the falling off of the PMIs in the US, and that is certainly not a positive for growth. Oh no. Okay, sorry. So basically, again, if you're when it comes to reading the PMIs, you're looking for basically anything around 50. 50 is considered the neutral level, whereby respondents pretty much are balanced in their sort of positive and negative answers in the survey. If you find data above 50, it suggests expansion in that sector compared with the previous month. Below 50 is contraction, and you can see here this is the market MARKIT, which is a private company that does all these PMI surveys. Their PMI for the US, basically pretty much anything above 52 tends to sort of drive growth. And at the moment we're falling back towards that, so that would certainly suggest that at the moment growth in the US is starting to stutter. And obviously we've seen the Federal Reserve hiking interest rates. So what does that mean for interest rate hikes, or the next interest rate hike? It's going to become increasingly difficult for them to do that if this PMI data continues to fall away and suggest that all these purchasing managers in the States are not as confident as they once were, and that is, as I said, considered to be a lead indicator. So how does it impact on all the markets? Well, just starting on growth, really. It's just, to be honest, it's fairly similar to the other data points. When you get stronger data, it has a stronger impact on the local currency. So, for example, what we have got here is the announcement of, Q4 GDP, preliminary reading of GDP. So, as I said, that is exactly 4 weeks after the quarter end, we get the first reading of GDP for the UK. And it came in line with expectations. And although it was in line with expectations, you'd say, why would the market jump on the back of that? Well, recently the economic data for the UK has been deteriorating and not so great. And subsequently, the market was probably fairly concerned that GDP was going to come out worse than expected. Now, it actually, as I said, came out in line. So the market took that with a bit of a puff of the cheeks and a bit of a relief rally that we saw on the back of that. And in terms of cable, we saw cable rallying from sort of 40, closing 42.70. In the next, this is a 5-minute chart, so in the next sort of hour or so, it was up 50 ticks. Even in the next sort of subsequent half hour, it's about 50 ticks higher. You saw cable moving. So these markets do move on this data, and it continued after a bit of a choppy move in late morning. It continued higher into the afternoon. So it does have a market moving basis. Now, once again, as per usual, as I said, it just is. The reason behind it is because it has an impact on future monetary policy expectations. So we're looking out for anything that gives or would potentially give the central bank reason to hike interest rates. That would be strong for the local currency. In this instance, obviously, sterling going higher because of UK GDP being a decent number. And it's all generally it tends to be all down to market expectations, but obviously in this instance it was more of a relief rally, that it wasn't sort of a worse number than the market had been hoping. Impact on bonds. What you've got here is a chart of the US Treasury yield, the 2-year Treasury yield, reacting to prelim Q4 GDP for the States. Now that came out on Friday, just gone. and we had an announcement that there was a disappointing move for GDP in the States. And subsequently you saw bonds sold off a bit, didn't they? Because the market sort of was suggested that the economy wasn't as strong as perhaps it could have been. So bonds started to sell off, and we saw a bit of support coming in there for the yield, and actually marked the low on the day of the 2-year, or certainly the low, low of the day, and then subsequently started to rally. So that's why. So you're looking for strong growth data as an indication of how well the market is doing. And interestingly enough, actually, what we saw here was GDP rallying a little bit, or certainly finding support on weaker data. Now that would obviously be that the market has been sort of so sort of driven by expectations actually of safe haven trading at the moment, that the states would be, and subsequently moving into into treasuries, that obviously the market had got ahead of itself, and there was sort of like a bit of an unwinding of that move. But the general sort of trend would be that strong growth data would be negative for bond prices and positive for yields. But in this instance, we saw a bit of a nuanced reaction there from the states, but generally that is the case. And equities, well, it's sort of just generally in line with sort of the appetite for risk, really. I mean, you had the S&P 500 reacting to negative or just disappointing manufacturing PMI data for the States, the ISM manufacturing data remaining weak, and subsequently the S&P 500 fell off quite sharply in the next sort of, this is a 1-minute chart, so fell away for the next 5 minutes, 5-6 minutes. I mean, it wasn't a massive reaction, and to be honest, this month you've had some odd reactions, I think, to this growth data. Both the GDP numbers and the ISM manufacturing data, you didn't really get too much of a reaction. I think that's generally because the markets have been so volatile and moving around on other factors such as the oil price, that they haven't really been reacting so sort of significantly to the growth data. But when markets are a little bit quieter and the volatility is a little bit less high, you do tend to get more of a considered reaction. But even though in this instance you did still see sort of a 5-6 point sell off on the S&P 500, again, admittedly not a great reaction, but I would still put that down to the markets just being still in this sort of state of turmoil, and certainly reacting to the oil price more than anything else. But the general sort of gist of it would be that stronger growth, I mean, just looking at the theory, if you take a step back and look at the theory of it, stronger growth means a stronger economy. Stronger economy means earnings potential is better for the corporates. People spending money is obviously better for corporate environment as well. So that should generally tend to be feeding through into stronger share prices. So stronger growth should be better for domestic focused equities. And gold. Well, the one reaction that we did get to the ISM data that I think was in line was again the gold price going higher. Gold's trading as a bit of a safe haven. It tends to trade as the opposite to anything that is strong for the economy, strong for gold. Strong for the dollar. So the gold price tends to react in a positive way when you get sort of negative data, and in this instance the gold price reacted by pushing higher on that ISM manufacturing data disappointment. So it went from 11.25 up towards sort of not far off 11.30 before sort of falling away. But generally speaking, you would tend to see that the gold price would be strong on this weak ISM data, and that was the reaction that we did get ultimately. So right. Let's have a look at some live market stuff because that's sort of the end of all that. No, that's the wrong one. What am I looking for? That one. Right. Oh dear. I'll look at FTSE in a bit because that will make me want to. Euro is pretty much flat, isn't it? It's not doing anything. Euro on the last sort of 2 months since that sharp move higher from the ECB meeting. You've had a second ECB meeting where the market's done very little. I think it was actually, was it that day, 21st? Might be wrong. And then a subsequent Fed meeting last week. Again, nothing really doing on that. And still the euro is going sideways. These indicators, these technical indicators are slightly, and I mean this with sort of a massive caveat, just very, very slightly bear bias. I mean, minuscule. And the only reason I say that also is because you've got this very slight downtrend and you're sort of pulling towards, again, further pressure, consistent pressure on that 108.10 mark. And I say 108.10, always say 108.10 as opposed to 108 figure, because that was the lows that we saw back in sort of May and July time, as opposed to 108 figure. But now what you're seeing is 108 figure tends to be coming in as more of that sort of support band. So anything back towards 108 seems to be supported at the moment. Again, we had that move last week whereby you had a strong run higher for 4 days and then a sharp correction that pulled it right back pretty much to the pip, to that 108.10 mark, and then rallied again. It's just buzzing around. It's not really showing any real direction, this euro chart at the moment, and it's difficult to really, because I've got to write something and talk about in my video every day. I've got to talk about the euro, and to be honest, it's a bit tedious at the moment because it's just not really going anywhere. You see these sort of minor rallies that sort of pull it up towards the 109.50 mark. Here we see the hourly chart, and again, I mean, look at that as a range, really. It's sort of every time it gets towards the sort of 109.60 area, 109.80, sort of falls away, doesn't it? Look at this, the hourly indicators, the hourly RSI, every time we get towards 70, selling off. Again, selling off. Sorry, not selling off, but again, you're sort of seeing the RSI up at 70, sort of rolling over. MACD lines beginning to roll over. Possible bear divergence on the stochastics as well on the hourly chart. So again, you're seeing this move up towards, not far off the sort of 109.40, 109.50 area. And you're seeing the indicators starting to sort of roll over again. So is this a possible shorting opportunity coming up again on the euro? I think it is. I think we're not going to be breaking out to the upside in this run. I think there's a lot of overhead supply between sort of 109.40, 109.90 that's going to sort of capture the next reaction high, because I don't see this as a strong run higher that's going to move on the euro. I think you're going to have to continue to play this range, and this little rally that we've got in the last couple of days is again that opportunity. Sterling is so volatile at the moment, isn't it? And last 5 days we've had 100 pips of open to close trading, and I say that because that's the the coloured bit of the candlestick. But it's up and down, isn't it? And again, we had the sharp move high yesterday, a bit of a retracement today. To be honest, today's been a fairly, well, a bit more quiet, isn't it, really? I mean, we were sort of 70, 80 ticks down at one stage, but rallied a little bit. You'd argue that the momentum indicators are pretty positive, aren't they, near term? Stochastics running higher, MACD lines having crossed and rising, RSI back towards 50. But look at this. I've drawn in a downtrend here on the RSI. And that's 1, 2, 3, 4, 5, possibly 6 points of contact on this downtrend, which would suggest there's an acceleration of the selling. You can see this sort of gradual acceleration of the move lower. Now, I'm not necessarily saying this is the high in this sort of little bounce, because obviously the near-term momentum is fairly strong, but you sort of you're now getting to the stage at which you're looking for probably the next sell signal, because the rallies are constantly being used as a chance to sell. That RSI got to 55 last time, currently 45, so there is possibility of further sort of upside move. But what I would say is I've drawn in the Fibonacci's, the retracements on this move of this big sort of December to January sell-off. And look at that, 23.6, the consistent hitting of that 23.6 before started to pull away. So it started to use that as a base of support, which is interesting. But breaking through 23.6, you'd argue you're now coming back to possibly towards 45.20 area, which is 38.2, which is again a bit of a minor support. Old support, which turns into new resistance. So there is the prospect of possibly a bit of an extension of this rally towards that 38.2% fib level. And certainly if you break back above yesterday's high 40, look at 40. Let me show you on the hourly chart. 144.45. 144.45. Which is that high there. But also the highs of the last 2 days. So for some reason 144.45 is coming in as your resistance. Then up above that 144.90, but for now 144.45 seems to be your resistance. It's coming and acted twice, isn't it? And the hourly indicators are also sort of rolled over, more corrective near term. So maybe we're going to get another retracement of this, but you'd argue that these moving averages are all rising on the hourly chart, and you're trading above them, which is a positive. But yeah, I mean it's a difficult one, cable, because it's so volatile, and it is very choppy. It's up and down. I mean, the base pattern that I had in place here, which was a head and shoulders reversal, actually got negated by this annoying correction, which sort of corrected you back from 44.10 to 41.50, so it's over sort of 250 pips of correction, and then you had a 300 pip rally, and it is fairly sort of difficult to follow on a near term basis because of all this intraday chop, and you're seeing the momentum indicators becoming far more ragged. This was more of a sort of a consolidation phase where the RSI was between 30 and 70 consistently in nice waves actually, but then you had that sharp sell-off below 30 to the buy above 70 to the oversold overbought position there. So it's a bit more it's a little bit more difficult to read, I think, near term. You'd argue that the old 43.50 pivot level is still sort of in place, although obviously the intraday move actually found a low of 43.25 today. You'd still argue that, but it's a difficult one, I think, near term. Obviously, you've got this resistance of 44.45. If you can break above that, then obviously you're away to 44.90, and obviously then you're talking about that 38.2% fib level. But as I said, the momentum indicators are nicely configured on the MACD and stochastics, but the RSI is back towards that level, isn't it, where the sort of downtrend comes in. So I think cable's a bit of a difficult one near term. Another difficult one is dollar yen, because we've had this sharp move higher, and it's retracing the move. And it's interesting actually, because we're now 60 odd ticks down on the day. We're getting a stochastic sell signal if we continue the way we're going. Not confirmed yet, but a sell signal nonetheless. You're also approaching 120 figure. Now 120 figure was the sort of caught these two lows here, which I'm taking as a basis of next support. but this move has certainly rolled over. You're seeing a sequence of lower highs now. That was 21.68, 21.47, 21.25, I think this was. No, 21.15, sorry. And then subsequently we've seen another move, hasn't it? Another lower high around, if I can get my crosshair on it. No, it doesn't want to do it. Let's get the actual crosshair. That's interesting, isn't it? Bit of support which came in there is now turning into new resistance. So 120.80, new basis of resistance, and again falling away. 120 is your first line of support, but main support starts to come back in at 119. And you certainly now seem to be retracing this move. And anyone who watched my video this morning would know that I talked about the Bollinger Bands. You had an entire candle outside the Bollinger Bands on dollar yen yesterday, and that would suggest really extreme trading on dollar yen. So it certainly is the case that dollar yen is sort of seems to be retracing some of that move now, and that crossover sell signal on the stochastics isn't going to help matters. Aussie seems to be a little bit unsure. Had this rally in this uptrend, which is pretty decent actually, but we're now testing that uptrend. You're also now back to the neckline of that base pattern. There's a head and shoulders base pattern in there, which I think was 71.90 if my memory serves me correctly. I think 71.90 was the initial target. And you're right back on that neckline now as we speak, pretty much, because it was 70.50 was that breakout. These two highs, 70.48 and 70.45, so pretty much 70.50 was the breakout level. And you're testing it, and not only that, you've seen the stochastics rolling over again. The last time we saw that, late December, produced that big sell-off, didn't it? So the other concern would be that we've seen the RSI unwind nicely back to a level sort of just above 50, but generally back to a level where sort of like the bears tend to start to get control again. Certainly that's what happened in December. Is that going to happen again in in early Feb? Watch out for a close below this uptrend, I would say. Let's see what the hourly chart's doing. Little bit of a possible top pattern there on the hourly. Yeah, 70.40 is a big near-term support, isn't it? Caught the low yesterday, catching these lows today. So 70.40, I mean, obviously that is around that neckline, isn't it, that I talked about, that neckline of the base pattern. If you make it bigger, you can see this base pattern much better. So you got left-hand shoulder, big head, right-hand shoulder, pushing higher. So right on that neckline, isn't it, at the moment? Testing that neckline. If you see the hourly RSI going below 30, that would not be good. You've already seen the MACD lines go fairly stretched to the downside, which would suggest that this uptrend, I mean, the uptrend on the daily chart is already broken on the hourly chart. Sorry, hold on. That uptrend is all. Oh no, it's not. No, it's not. Sorry, I thought it was a bit tighter than that, but it isn't. It's again, that's being tested, really tested. But look at the moving averages as well. Moving averages, yeah. I mean, they were rising nicely. They're now flattening off on the shorter term, beginning to turn down, beginning to get some sort of sell signals on the hourly. So it's beginning to really test the bull argument, isn't it, this one? So watch out for that. That's an interesting one to watch, I think. Kiwi. Sorry, that's frozen for a sec. Hold on. Yeah, I don't know why that's not worked. Come on, that's better. Right, Kiwi. Yeah, it's sort of a bit of a slow burner, isn't it? It's not really done the base pattern that the Aussie has done, but there again, it hasn't really been under so much, hasn't got the corrective signals either sort of a bit more neutral, I'd say, but you're trading underneath the 66.15 pivot level. I think 66.15 is an interesting level actually on the Kiwi. Caught the lows, caught some highs, lows, highs, lows. Anything towards 66.15 I think would be a sell, I think, on the Kiwi. You've got this unwinding momentum, but you're not really seeing any upside, are you? Not really seeing the move pushing higher. Now, we saw the support forming around that old low, that old November low, 64.25, that low. It didn't really ever sort of decisively break that support, and to be honest, you had a fairly positive bull candle there, didn't you, on the 20th? But it's not really taken off, has it? Not really gone. And today's move is sort of a little bit corrective, isn't it? And yeah, that's not great. Not really moving it. Right, sorry, Gilbert, I hadn't. Is that working? Yeah, sorry, that's working now. Sorry, guys. I must have just hit mute accidentally. Right. So yeah. Sorry, Gilbert. Just going back to the fact that we're talking about the PMI data for tomorrow now. It's services PMI tomorrow, so that is the big factor, I think, for cable. And cable, I think, is going to be something that will move on services PMIs. It does tend to do so because service sector in the UK is about 80%. So basically, we're looking for a better than expectation move. So how's that going to come up? Now, let me just get tomorrow's data up. So let me just find it very quickly. Right, 3rd of Feb, UK service sector PMI chart. So I'm just going through my Reuters here. Right, so the expectation tomorrow is 55.3, so very slightly below where it was last month. I'd still say that's a pretty positive number. But 55.3 is obviously a 2-month low. It'd still be, I think, a pretty positive number, still to be taken positively, but you're looking at the expectation. The market is factoring in 55.3. So anything below that, I think cable would fall on. So what you're looking out for is putting out, I'd say wait for the data, because survey data is certainly notoriously sort of difficult to predict, I'd say. And I'd say trading in front of the data is going to be a risky game. I'd say that makes it a 50-50 trade. I'd say wait for the data and put the trade on the announcement of the data, because I think cable does tend to move quite strongly with the PMI data for service sector. So you'd be looking to go short on cable if you had a weak number, say 55, 54, something like that. If you had a positive number, then you'd be looking to go long cable. I'd say put the trade on after the announcement has come out, because it is a difficult number to predict. I hope that is helpful for you. But yeah, 55.3 is the expectation I've got here according to Reuters. So where were we? We were looking at Kiwi. We've done Kiwi, so let's look at the CAD now. What does this tell you about the market? This is really my trigger signal that I'm taking at the moment. What is the CAD doing? Because CAD, or certainly the Canadian loonie, runs around with the oil price. So stronger oil price means stronger CAD. Stronger CAD means a falling dollar CAD. So therefore, today we've seen the strong sell-off on the oil price, and we're seeing CAD, which is rallied. And not only that, it's rallied from this big uptrend that's been in place since October. You've also got a potential buy signal on the stochastics. The RSI rallying from 40. You've seen a move back into this support band. It looks like dollar CAD is about to turn higher again, and that I think would be negative for oil. You remember that chart, and sort of the opposite of that chart is pretty much the oil price, and we're seeing the oil price falling away. And what's the oil price doing? It hit below $30. If it closes below 30, oh god, that's really negative. You've got sell signal on the stochastics. You've got the RSI, which unwound to 50 and then fell away again. Third time that's happened in the last 3 months. Each time that's happened, each time the RSI has hit this level, mid 40s, 50, fallen over, that's been your sell signal. Sell signal on the stochastics rolling over there again, third time. Each time the stochastic sell signals come through, we see these sells, the top in oil. It's not positive, and that is going to be negative for market sentiment generally. Markets are driving off this oil price still, and that is not good. If you saw WTI below 29.25, which is the reaction low from early last week, that would certainly, I think, then suggest you're going to come back and test the 26.20 mark. It doesn't look all that great. So the oil price is under pressure again. A couple of days of correction in a row, and it's already lost 34.80 back to 30. Well, that's sort of 15%, isn't it already? That's not bad. That's not great. Certainly not good for market sentiment generally. Falling oil price is a negative. It is negative for markets. Looking at gold. You've still got the uptrend channel on gold, which I like. Didn't draw the upper part of it, but there we go. There it is. So that's a positive, and I think it's looking pretty good. Yesterday's breakout was pretty nice, above the 27.80 level, which was the resistance from last week. So you've broken out already above last week's high. You've also got pretty strong momentum indicators, haven't you? I'll get the RSI and go like that. Pretty good, nice sequence of higher lows. You've got obviously that run higher in the MACD lines. And the stochastics are still looking strong. So there's no real reason why gold can't continue to go higher at the moment, I think. I've drawn in this red line here, which signifies the underside of the old key lows of 1142 from 2014, 2015. I think that's a pivot level on gold. It certainly has acted previously as a sort of a pivot level. Sharply broke through there, so I'd still say that that's sort of my target area, sort of 1142. Now you've got this base pattern in place. That base pattern gave us an upside target of around 1132. So you're not too far off achieving that base pattern. So the near term outlook is still positive, and it's looking even good on the hourly chart as well still. So I'd still continue to back this gold price higher. I'd be using little rally, little corrections as a chance to buy. Now I've got the crosshair in there about 1122. I'll break out. Bit of resistance around, bit of resistance around 1122, isn't there? That was broken through, becomes supportive now. So that is a minor support level. There's a fairly reasonable level around 1120 as well, and the key level near term is 1110, which is these lows here. But it certainly seems to be that gold is on the way up and continuing higher. So thank you very much for listening today. Here's my, if you want to go onto Handset Markets website, my research page is where I post all my stuff. Also got my videos, my weekly video, all my daily videos that get done every day are all on there. My Twitter handle is @HandtechRich. If you want to follow follow my stuff, my comments. And I leave you therefore with the disclaimer. And I wish you good luck with all your trading, and I'll speak to you again next time. Thank you very much.